So my key learning for 2020 is not so much a learning, but a timely reminder. When we look back over the past decade, markets have stayed relatively calm and buoyant, right since the GFC. You know, we've had some market stress at the tail end of 2018, but it was really just a bump along the road. Now, the crisis that was brought about by the coronavirus and the emergence of COVID-19 is one that, you know, whilst we don't have a direct comparator from a pandemic point of view for over 100 years, it really relates to, you know, crises that we tend to see every 10 years. So it's a fairly regular market occurrence. And so that reminder is that, you know, risk is ever present. Just because it doesn't show its face doesn't mean it's gone away. Or to take a statistician's phrase, absence of proof isn't proof of absence. And so, you know, when we look at our own homes, we all have fire insurance on our homes. That's not because we think our house is going to burn down anytime soon. It's simply because we're aware of the risk. And ultimately, when it comes to investing, the same thing applies.
One of the biggest learnings, I think, for myself for 2020 was that no matter how unlikely an event may seem, particularly when everyone else thinks it's close to impossible, it can still happen. So thinking differently, particularly about, you know, the various different outcomes that could happen, is really key. In 2019, it definitely seemed as though risk assets were just going to continue rocketing. And if you had thought like consensus and extrapolated those returns, you know, you would have had overweight equities for fear of missing out, and you probably would have been really badly hit in March, in the March drawdown. So thinking differently, and particularly about the risks that are on the horizon, is really key. And to emphasize that point, in order to be truly prepared, I think you really need to focus on having robust portfolio construction. So that means you're having a measured and balanced exposure to assets that are lowly correlated with one another. That's really important. If you didn't have that, what a lot of people would have done after that March drawdown is panic sell, and then they would have missed out on the subsequent rallies, which would have hurt your portfolio even more. So, I mean, as much as they're learnings, they're also confirmations of like key concepts, which is thinking differently, being prepared, and having that robust portfolio construction. And that's what's really going to get you to that strong, sustainable investment portfolio.
I think one of the interesting things about market events during 2020 is that there were enough participants around to have remembered 2008. And so you did see people and investors react like the crisis would have occurred in 2008. However, the difference was that central banks and governments reacted a lot more quickly to the events that unfolded, and as such the crisis had a very different flavour. Not to mention the underlying winners and losers in certain industries, and so that was quite a different aspect of the crisis. However, the central bank intervention prevented a lot of things occurring that happened during the GFC, and most notably for me was credit. So the reaction of markets during 2008 and where the reaction of credit securities was much more tempered because of the central bank intervention. So if you were following that playbook, I would think that investors would have found that that would have been a difficult trade to make. And so it once again teaches us that trying to position portfolios through these events can be really problematic. And you do need to position advance with a more diversified portfolio and not have single bets or single moves in reaction to things. So I think that's a really good lesson for investors.
One of the key investment learnings for me this year is around correlations and share price performance during market corrections. We have seen in the past that correlations tend to increase during market corrections, so that's nothing new for many investors. But what really surprised me is that stocks or sectors previously perceived to be defensive didn't hold up well at all, and in many cases they actually underperformed the market. Some examples that come to mind are infrastructure names such as Sydney Airport and healthcare stocks such as Integral Diagnostics. Integral Diagnostics is a well-managed company that specializes in imaging services. Demand for imaging services is very stable and very easy to predict. But given government constraints on some surgical procedures, demand for imaging services declined significantly, and that put pressure on earnings in a way we've never seen before. The same can be said about infrastructure names such as Sydney Airport, which was impacted by the travel ban, so that history of stability is no longer there. The bottom line here is that history is just a guide and every correction is different. This pandemic has caused structural shifts in the market that was unexpected and very difficult to predict, especially if you're using history as a guide. The main implication is that investors should be well diversified, and not just within the Australian equities asset class, but also across the whole portfolio.
The biggest learnings for me in 2020 is that the investment process does work. It's more a confirmation that what we do is robust and sound, and that's the best thing for our clients and for investors. Many clients were concerned and worried throughout March particularly, and the following months, and looking at the way that the investment markets performed, it's very clear that staying in the market, setting up your risk profile and your asset allocation early works well, and sticking with the plan is the key to long-term investment success. I've had a number of clients talk to me about timing the market and looking to reduce or increase their risk throughout 2020, more so than any other year, given the volatility that we've seen in the investment markets. And the thing that I keep coming back to is how extremely difficult that is. And when you're trying to time the market, the issue is that you're not just making that one decision to time the market now. You have to make the decision to time the market now, but also to time the market the second time when you either increase or decrease your risk back to your preferred risk profile. And that is really the tricky one. When the markets are going crazy, it's very intuitively simple to say, okay, it's time to get out or it's time to get in. But the thing is that while it may be somewhat clear at that point, the reality is that it's not. And trying to make that next decision in 2 months' time, 3 months' time, a year's time is really difficult, and that's when you can miss the market.